Chris Whitenbach, Chicago Title, National Commercial Services again. I'm here with Jonathan Frizzell, is that right?
That is correct, Chris. Very good.
Okay, very good. He is a cost segregation expert. And I know right off the bat, the question is going to be, what is cost segregation? So if you can just take a moment, we're talking about in a function of commercial real estate, investment real estate, I guess, because it does sound like you do residential as well, and how you apply that to real estate and the cost savings that can be associated with it.
Sure, Chris. Thanks very much. Good afternoon. So, commercial real estate in a for-profit entity is either going to mean 39-year depreciable life or 27.5, which is multifamily, single family. So what we can do with blueprints and drawings and on-site visits, we can go ahead and reclassify those assets into shorter depreciable lives of 5, possibly 7, certainly 15-year. And then whatever's left over will be in the long lives of either 39-year or 27.5. So at the end of the day, we're accelerating the depreciation as opposed to increasing it.
Okay, and are there any specifics as to how you can make that happen when a previous tax return has been placed, or what are the restrictions on that?
Actually, great question. No restrictions as long as the property improvements were placed in service. This is per the IRS code after 86, meaning January 1st of 1987. And we'll certainly look at other improvements since the time of service. So it's any kind of for-profit entity of any kind of property, you can go ahead and have a cost segregation study performed, as long as it's been in service after, or improvements after 86, meaning January 87.
Okay, so walk me through an example of how you would apply cost segregation.
Well, what we do is that whether it's a multifamily at 27.5 year, maybe you got some office or you've got a distribution warehouse, which would be 39. What we normally get from our clients is the most recent federal tax depreciation schedule, which right now would be 2018 or 2019. We're gonna see on there a building basis and a land basis. I'm gonna go after the building basis. Sometimes there's not a land basis, meaning they're on a ground lease. So they own the business and the building, but not the dirt, because they still qualify. And I'll be able to calculate, and by the way, I need a physical address. I'll go up in the sky and I'll go ahead and take a look at the property from the clouds. And then I can go ahead and estimate what my team and I are going to get into 5-year depreciable life, 15-year, and then what will be left over in 27.5 or 39-year.
Okay, and so what kind of cost savings are you typically finding for your customers?
Well, you're looking at, that's a wide range. Just with a quick preface or caveat, it's predicated on federal, possibly state income tax, what the combined rates are, and then what type of real estate what kind of product it is. But you can feel comfortable with 7 to 10%, anywhere from 70 to 100K for every $1 million basis. You can go as low as 5 or 6%, 50 or 60 grand. And of course, I've hit it out of the park, well over $250,000 of the $1 million basis. So in short, 7 to 10% of the basis at the time of service.
It's an incredible amount of savings that I'm understanding a user or owner might not typically enjoy if they were just applying it to their cost or their tax professional. So it's important to note how much of a different service that you apply, even though it is a tax savings. So can you talk a little bit about how you were telling me how it's a little bit of an engineering function, but it's also can be a tax savings function as well?
Yeah, it's definitely an engineering function. It's all engineering on the front end. And then upon deliverable, then it becomes an accounting function. So for instance, if you have a property that's been in 1 year in service, meaning it's already had a return filed on it, or 10, 12, 15 years, there's a thing called a 41A adjustment. We can help the CPA or the tax professional on that. But as far as blueprints and drawings and appraisal, and then myself or one of my engineers that does the on-site, so we document the improvements digitally. that's where we're documenting literally everything. And even what the naked eye can't see, we'll know what's inside those walls because we're going to count on what's outside of those walls. Telecommunications, cabling, DSL, it goes on and on and on. GFIs, interior, I get very excited over GFIs. Interior, exterior, it's all 5-year property as opposed to 39. So in that sense, it is a counting function. The on-site reviewer is certainly, I'm doing a lot of counting and I'm snapping hundreds of pictures as well. But really at the end of the day, you got the square footage of the footprint of the actual tax parcel, then you've got the footprint plate of the building, and then how many floors. So it's still really more of an engineering function. And then upon delivery, then it becomes an accounting function. And then it's important that we stick around there to help the tax official and the client to go ahead and apply it to their return. And then they can go get their money back from last year. And then we'll talk later about how you can carry it back 5 years on the CARES Act.
Okay, so it's a good question is how many times can a person do a cost seg study on a particular piece of property?
Usually just once, Chris, and then, and then of course, if there's significant CapEx, projects after the delivery of the cost segregation study, certainly you can have another one done on it. But as far as going after the original basis that's on the federal tax depreciation schedule, and then of course any subsequent improvements thereafter, that's a one-time study. Now you have to always remember the patriarch or matriarch or significant partner of the subject LLC or the tax entity itself. If they pass away or sell out or what have you, you've got a big step-up basis known as the Section Code 754 adjustment, and then you start it all over again. I'm doing that with a family in Seattle right now as we speak. That was referred to. So, mom passed away in February. In fact, dad's not doing too well either right now. But anyway, there's a step-up basis for the son and the daughter, for brother and sister, and so they want me to go ahead and take a look at it. Even when most of the properties are fully depreciated, Chris, there's a nice step up basis. So I'm going to go after and attack that number. And then I'm going to give them I'm going to give them full expanded detail on the personal property and the real property. So when they improve their properties, as they're going to, they're going to know the value of what's being thrown in those dumpsters, not only in an open tax year 19 and 20, but also in years going forward. That's we may or may not have time. That's called partial asset disposition, or full dispositions, FADs, PADs.
And you touched a little bit on it. Is this something that you are limited where you can give your services? Is it a nationwide service, or are you limited to Washington State?
No, I'm in all 50 states of our republic. I'm disclosed on a portfolio in Oklahoma and Arkansas. I did another one in Arkansas. Now I'm finishing one up in LA. I'm all over the place, south, east. I love what I do, and I've done work in Hawaii as well. So yeah, and Alaska. So you bet.
Well, and you're very good at it too, and you market yourself well, and you have this plethora of information that's just stored up in the old noggin that it's tough to really get everything out on one individual Zoom call. So I definitely will put your information at the end here for people to reach out and contact you, as we could talk all day about cost seg. Now, I know that you wanted to touch on a couple of things first before we go, though. One being the bonus, and then also the CARES Act. Do you want to go down and discuss both of those?
I do. And then just a rule of thumb very quickly, whether I can't remember if we covered it or not, but you're looking at about 7 to 10%, for every $1 million basis, 70 to 100K, depending on somebody's effective tax rate, federal and or state. And then of course, what type of property it is. But to answer your question, on the partial, I got the second part. The first part, Chris, was?
You wanted to identify and talk about the bonus?
Yeah, the bonus. Great question. So when all heck broke loose in New York in 9/11/01, young Bush and Congress passed a thing called bonus. And bonus is defined as anything less than 20 years or less depreciable lives. So, and it used to be just for TIs, leasehold improvements, new construction, and then they would vary it, they being Congress, and then with the IRS, to keep the economy going. I mean, we had 100% bonus on all TIs improvements, new construction, in '08 when the last recession we had. And so, but now what's very powerful in the Tax Reform Act that was passed 3 years ago in February, retroactively, President Trump pushed hard for that, meaning after September 27, 17, all acquisition now, even used property, is subject to 100% bonus depreciation. Well, what does that mean for new acquisitions after 27th September of year 17? That means literally any type of property that's a for-profit entity, you get the cost seg benefit in the first year, and then you can carry it forward. Now, the old days on acquisition, whether it was spec development or older properties used and what have you, you got the cost seg benefit the first 5-6 years, as opposed to 27.5 or 39 years. So it's huge. That leads us, by the way, Chris, to the CARES Act, if I may, where, now it's even more powerful. This is my second rodeo on five-year NOLs, 5-year net operating losses. In the middle of a Friday night on the 27th of March of this year, Congress and President Trump signed the CARES Act. And the two most important things, very, very powerful, very optimistic here, is that you're not forced to carry losses forward. You have an options on tax years 18, 19, and 20, where you literally can carry your losses back and go get tax refunds from prior years. You can do that through a change of accounting method 3115 form, or even simply amend your 18 returns. And I've done a ton of those early in my career in '08, '09, and 2010. And that's huge. And are you interested in the second most important part of the CARES Act, Chris?
Why wouldn't I be? Of course.
So the QIP, qualified improvement, inadvertently, in the infinite wisdom of our IRS friends and Congress for that matter, they inadvertently took away QIP, qualified improvement, and it was back to 39 year, even though it was 15 year all day long automatically for retail and restaurants and any kind of TIs, leasehold improvements, any kind of interior improvements. So we've been kind of sweating, for about 2.5, well, it was actually 2 years, 2 years and 1 month to be exact. We got a correction on that. So now QIP is for interior improvements, that is, on commercial property only, by the way, 39 year, not for multifamily, or commercial property only. It's subject to 15 year automatically, and you get to go back now. I'm very excited about that. So even when you filed your 18 return, you still get to go back now and qualify those QIP improvements as 15 year. And what does that mean, Chris? That means 15 years subject to 100% bonus, which is what we have and have had. So guess what you get to do? You get to write it all off, depreciation expense. You're forced to do 39 year or do a cost seg. We'll get 7.5, 7.15 left over in 39. Now, bottom line is it's all expensable, and you get to go back to 18, that whatever that was capitalized over 39 year, as long as it's interior, of course, within the envelope. Here's the good news. You get to double dip on this. You weren't allowed to double dip before. It was one or the other. If you make improvements, you can't expense something and try to dispose of. But this, you get to not only providing its interior improvements again on QIP, and qualifies for qualified improvement. Not only do you get to expense those CapEx that are normally capitalized, we're going to get you a nice disposition opportunity. We're going to find out, Chris, what was thrown in those dumpsters in tax year 19 and 20. So there's a lot of ways to skin the critter, if you will.
Curious where you were going to go there with that.
We're not. You're always curious that way, Chris. I was going to say cat, but I got in trouble at a seminar for saying there's many ways to skin the cat. I think
you got to be careful these days, right?
Yeah, this is all the shoelaces are tied, right, Chris?
Right. Well, so then it's very clear that this is a powerful tool that I'm sure not a lot of people are engaging in order to have cost savings, depreciation savings now, as opposed to waiting and slowly enjoying it down the road. Is that correct?
Yeah, you're getting it up front. And here's the good news. If you work with a true engineer-based cost seg provider, you can use the Cost Segregation Study as an asset management tool. It fills a toolbox for your tax professional, fills a toolbox for the client, the owner, as well as in-house accounting. So when you start improving your properties to keep the tenants you want, the ones you don't want, and the ones you're trying to attract, right? In the world of IRR, is that you get it off the book. So it's very powerful. I mean, when you're replacing RTUs up on the roof or HVAC or siding, land improvements, curbing, I can go on forever, as you know. You can get it off the books, Right now in our country, we have tens of hundreds of billions of dollars of double assets on the books that need to come off the books. We've got double assets on the books all over the country, and as we know, Jonathan would just love to look at those schedules and clean them up.
Right, and that's what you're here for.
Yeah, I had a client once that told me, he says, Jonathan, how I describe my competitors and my clients to you is you're nothing more than a custodian and a janitor of depreciation expense. What do you think of that one, Chris?
I like it. I like it. I think that's perfect. A great antidote to finalize things here.
You bet.
Well, why don't I put up your contact information here real quick?
Yeah, anybody can contact me. I'm good for 5 a.m. till 7 p.m, 5 days a week. So, they call me area code 206 399 7769, and then there's my personal business email at jfrizzell@shstrategies.com, which is my old startup, Safe Harbor Strategies, and I'll have that email until I'm in a wheelchair, Chris.
Beautiful. Hopefully further away than sooner, right?
Oh, I love what I do. It's very important to enjoy what you do. I'll be doing this well into my 70s and longer. Some people just live to work, and some people work to live. I'll let you guess which one I am. So
yeah, I think we can all safely guess as to which one of those you are. Well, thank you so much, Jonathan. We will send out your contact information, and we'll find ways in order to do business together. And thank you so much for taking the time today.
It was really a privilege, Chris. Thanks very much. I wish you a wonderful afternoon.
Thank you too.
Thank you. Bye-bye.